Next up, we have a conversation all about the outlook for global credit in 2023. This was a huge topic of conversation yesterday at the Private Credit Forum that we hosted, and I'm delighted that you all will be here to listen to some of the insights shared on our next panel. So please welcome to the stage the moderator for today's session, Kristen Jones, Head of U.S. Private Credit for Alborn, and her three guests, Elizabeth Burton, Managing Director at Goldman Sachs, Soraya Chabarak, CEO of CQS, and Alex Popov, Head of Liquid Credit for Carlyle. Kristen, the stage is yours.
It's cooler out here. It is cold out here. Good afternoon. Thank you for joining us. Welcome to the Global Credit Outlook panel. My name is Kristen Jones. As Michelle mentioned, I'm the Head of Private Credit Research at Alborn Partners. We're a global non-discretionary panels consultant. In this session, we're really hoping to take you all on a bit of a journey across public and private markets around the globe, from the seat of LPs and GPs. There's been a lot of conversation around some of the topics that we'll be touching on, but we have three incredible credit practitioners up here, and so hoping to dig a little deeper, have some really interesting conversations, and hopefully you walk away hearing something that's either an interesting dinner conversation or you can take back to your teams next week. But I'll start by asking each of you to just briefly introduce yourself and maybe give us a little bit of a lens on sort of what perspective you're going to bring to the rest of the conversation.
Sure. Elizabeth Burton. I'm an investment strategist at Goldman Sachs. I've only been there a few months. I used to be the CIO of Hawaii Employees Retirement System, so I have the least impressive resume up here. So I think that I will bring the perspective of a former allocator who can now be really honest and open about allocators and investing in credit.
Thank you. Soraya.
My name is Soraya Chabarak. I'm the CEO at CQS Asset Management. CQS is a London-based, headquartered credit specialist. We do have offices in the US and have been there for a decade. We manage global portfolios across credit in liquid and semi-liquid strategies. So as opposed to my friends around me who are in predominantly private debt, we're in liquid and semi-liquid credit across ABS, loans, high yield, a little bit of investment grade. We issue our own CLOs and we invest in other CLO managers as well. And Reg Cap is a real theme for us and hoping to unbundle that.
Thank you. Good afternoon. Alex Popov. I'm the head of liquid credit at the Carlyle Group. Within Carlyle Group, we invest across the credit spectrum from liquid to illiquid to real assets. I oversee the liquid part, which is everything from direct lending to opportunistic credit and special situations. So I'll bring the perspective of investor in the markets on a global basis between US, North America, Europe, and Asia.
Thank you very much. I know we're all students of the markets, and every day we're consuming more data, more information, trying to figure out what it's all about. This panel is not meant to be macro-focused, but it's hard to talk about credit without a bit of backdrop, I think. From my seat talking to GPs and LPs every day, it feels like there are a few common catchphrases that I'm hearing right now, most widely telegraphed recession in history, the golden age of credit. It feels like there's a true consensus view in a lot of ways, which to some can be a bit dissatisfying. But nevertheless, I think that heading into some form of a recession, whether it's an earnings recession, just a dislocation, a garden variety recession, there will be opportunities, feels like the consensus. Soraya, if you wouldn't mind starting with, you again have a little bit more of a liquid lens. What, could you guys kick us off with a more economic market backdrop update and what you're focused on?
Sure. I mean, I think touching on what you said, Kristen, there's a definite consensus that given what happened in 2022, credit is well set up. It's got a tremendous tailwind behind it. But I'll stop there, because that's where I think the consensus diverges a little bit between liquid, semi-liquid, and private. I think it's definitely true to say that the forward yields that liquid and semi-liquid, certainly credit presents are very, very strong. But you need to take a step back to sort of understand where we came from in 2022. We came from a world where we'd had 10 years at least of QE. And in a QE environment, all boats float up. Most of us made money, in that environment. Today, we're entering a world of the end of QE. Rates are rising and have continued to do so. To your point, recession could be on our doorstep. There's a lot of uncertainty. So I think, whereas the consensus is it's going to be a strong year in 2023 for credit generally, I think that we would argue that it's going to be a year of dispersion, where you really need to go back to the toolkit of making sure that you're selecting the right credits, you're in the right sectors, you're in the right geographies, and you're finding that relative value between those sectors and geographies. Defaults are set to be quite high, a lot higher than what we've seen in the last 10 years. So, 4% and 6% in 23, 24. So really being able to do that fundamental work and dig deeper and understand how to extract the income that the credit asset class allows you is going to be key. And finally, I think that one of the things that we're feeling emerging from allocators that we're sitting in front of right now is the question around the real repricing around risk. How much risk do I really need to take? How much illiquidity premium do I really need to take to make the returns? If you look at last year, investment grade, US investment grade backed up some 15%. US high yield backed up some 11%. And so the forward yields look pretty attractive from here. But with default rates increasing and dispersion and volatility, we think still, in the mix, it's going to be very, important to identify those winners and those losers. And we think you can make, good 10 to 12% type returns that allocators are looking for from liquid and semi-liquid product. I apologize for going ahead of you, Alex, because I know private debt still presents good opportunities, and I'm sure you'll talk to us about that. But we would argue, the era of selection and being highly selective, being in the right asset classes at the right time in liquid and semi-liquid product really presents an opportunity today.
Well, that's great. Let's go there, Alex.
Yeah, let's go there. And I like the idea of having some good banter here about better opportunities or not. Maybe I'll take us a little bit back further because I think historical perspective is important. Last time we were in a situation that's similar to this one, global financial crisis, illiquid credit was $200 billion. Fast forward to 2022, the overall sub-investment grade market, which includes broadly syndicated high yield plus private credit, is a little over $3 trillion, and over 1/3 of that is private credit. So the first important point is the increase of private credit as an actual solution to companies and a very attractive relative value investment for investors, for allocators across cycles. Now, I do agree that over the last 10 plus years, particularly over the last few years, we've had substantial stimulus and aid. However, selectivity mattered over the last 10 years. It mattered over the last 2 years, and it's certainly going to matter going forward. Going forward, one of the things we're seeing from borrowers is preference in certain ways to a private solution. Broadly syndicated loans and high yields are more of a box of, if you fit in there in a good market, you will get the best execution for cost of capital. Those markets are not there when you need them. 2022 is an example of this. Between broadly syndicated loans, high yields, I throw in M&A a little bit in there, but those markets were down something like 60 to 70% in terms of new issuance. So all that demand, people still either need to transact or want to transact for an opportunistic value add, is coming through private markets. And I would argue that today, And in the foreseeable future, the private markets are the arbiter of what transactions get done, what transactions do not get done. And the private markets in credit have the ability to extract the relative value. One more thing to add, the important thing going forward, and historically, but really going forward, it's not only allocating capital, but also what do you do with those portfolios when you've invested. Having the platform to provide value to companies, to provide a backstop to your investors in the event things don't go well, that will create a meaningful dispersion in returns going forward.
How impactful is the capital flow dynamics that we've been seeing, and how much does that vary sort of between your two markets, do you think?
Well, I think we talked a little bit about it before. You know, we have the economic backdrop is one of the things we have focused on, but capital flows is the other. 2022, capitals, went out of the liquid credit markets and have not yet come back. Some of those are structural reasons. For broadly syndicated loans, it's hard to make the structures work with rates where they are. Another thing we need to be all mindful, we are about to hit a wall of downgrades. CLOs are not allowed to own certain downgrades. That will create opportunities in the secondary market, et cetera, but it is not a good set of circumstances for flow of capital. High yield may be a little different. There's certainly at this levels, it starts to hit the threshold for some investors, a lot of it due to risk-free rates, but it does start to hit. So you may see some flow of capital back into high yield. But yeah, I think it's going to be a story of where the capital is being formed. In private credit, it takes time, but over the last 15 years, it's been a tremendous growth.
That's great. I think the allocator perspective is the natural place to go next. I spend a lot of time in my seat talking to LPs about this public versus private dynamic, how much, when, et cetera. What's the mindset you're seeing and hearing and thinking about with those that you work with?
So it varies dramatically between US clients and ex-US clients. So I would say that our US based, so I work on the retail and institutional side, are much more risk off. I would say that outside of the US, clients are much more risk on, except for maybe the UK, but across the board, I would say they're much more on the ground hunting for deals. Like our offices, we are having a lot more people from abroad come in and try to start kicking the tires. But there's a couple other things that I think are kind of interesting. So first of all, like I actually traded mortgages in the credit crisis, and I'm 40. So everyone like younger than me in this industry hasn't necessarily been through these sorts of cycles. So I think it's going to be a challenge for people to get comfortable with that kind of dispersion that I agree with you that we're likely to see. The second trend I'm noticing is that while allocators are saying we're interested in credit, I haven't seen a ton of people pull the trigger. Or if they do, they're talking about on the private side, like direct lending, and I kind of want to be like, okay, there's like 40 different kinds of private credit, and a lot of these other strategies are really interesting, and some of them focus on some of the sectors that I think are going to be really constructive going forward. And then I would say the last thing, to your point about public versus private, is my personal opinion, and this is like pretty much the only time I miss being an allocator is when I see something I want to do and I can't do it anymore, is like hybrid capital structures. I think if you are able to execute on public-private hybrid capital, that you're really going to be in a great position going forward. I think that's easier for smaller investment teams to do with 2 or 3 people than it is, if you have a 100-person investment team and someone just does liquid and someone just does illiquid. But I think it's going to be really important for people to be a lot more flexible in their thinking on asset allocation going forward. I don't think that's I didn't say anything earth-shattering, but I think if you can get really creative, not only does it kind of solve some of your liquidity type of issues, like if you can go ahead and put public credit in and then kind of pivot. So those are like the 3 main things that we're hearing now. And I'm not saying that you should be going outside of the US just yet, but it does worry me to the extent that some allocators are not out there at least, like filling up their Amazon shopping cart, even if you're not hitting like buy yet. You should have an idea of what you kind of want to do or who you want to partner with.
No, that's really interesting. It feels like the menu options for credit investing has continued to grow almost exponentially, it feels like, over the last few years. And at the same time, there's a real blurring of lines between what used to be, liquid traded credit versus direct lending versus special sits. They were quite distinct buckets when I started doing this 15 years ago. Now everybody does a little bit of everything. It feels like half of my time is spent decoding what capital solutions means versus special sits versus opportunistic versus multi-strat versus tactical. I mean, literally the list goes on and on. And I spend a lot of time with clients trying to figure out what is the right approach. Do you put sort of a constellation of specialists together? What's the right liquidity approach? You provided some insights there. If you have anything else to add, and then I'd also love to hear you both run different products with different mandates and approaches, sort of your take on best ways forward for LPs in 2023 to tackle this very unique opportunity set that we're heading into.
I think we're saying sort of liquid, semi-liquid versus private credit. I don't think it's a versus. I think the two worlds, to your point, Elizabeth, are merging a lot more. And I think the case that we make at CQS, by virtue of our platform, the ability to pivot into different facets of credit, is that you can actually get returns in the liquid market now that are more attractive than they have been previously. But in the same way that we've always believed you should be getting that income into your portfolio, which is being highly selective. And so, the areas that we're excited about in liquid credit are also highly selective. So we're super excited about financials in Europe, for example. Today you can go out and buy Barclays Bank and IG credit, very liquid IG credit, and get yields of 8-9% into your portfolio. That's a lot of yield for an IG name.
Yeah.
And then if you go further down the spectrum, we're super excited about CLOs in the double B space. If you think about what happened last year to CLOs, they backed up some, 15, 20, 25% in the different tranches. And today you're sitting on, 900 to 1,000 basis points of spread with yields and income of 15% in the forward. That is an opportunity. Do you go out and buy that opportunity on a standalone basis? Maybe, depending on how you are in your portfolio. But at CQS, we believe that you can blend these opportunities, both on the liquid and the semi-liquid side, to start building up a return profile. And the last area, not the only area, I'm just picking sort of areas that I think are really prevalent to the environment that we're talking about. For us, regulatory capital, significant risk transfer in the banks, specifically in the champion banks in Europe, is a very important trade. It's floating rate in nature, so helps with the fact that you've got interest rate rising. The majority of the collateral is IG. You're risk sharing with the banks who have a need to transact. And those type of returns are coming in at anywhere between 12 to 14% for a 5-year sort of locked up vehicle. It takes me back to where I started, which is if we were having this conversation 3 years ago, I'd be sitting with Alex and he'd say, private debt, we need to go out 8-10 years to make 12, 14 plus type of returns. The argument we're trying to make at CQS is that liquid credit in the right areas selected properly can give you strong income, which is what I think you buy credit for. Combine it with some semi-liquid, to your point, in some sort of hybrid structure if you've got the platform to be able to do that. And there is also room for privates, which still present a lot of value.
I mean, I want to agree with something that the panelists have said. The market is converging between the two, and we see it every day in the world out there when companies are going out to raise capital. They don't thinking liquid or private. They're looking for capital. They go talk to their advisors, reach out to their relationships, and they're looking for the best solution for them. And there's plenty of situations over 22 where it has been a combined solution between broadly syndicated loans, high yield bonds, privately placed solutions that work together across the risk return spectrum, sometimes sitting side by side, sometimes in different parts of the capital structure. So as the markets are requiring more capital, there is meaningful convergence. And yes, there has to be premium for somebody to lock up capital for in a long-term format for 3, 4, 5, 6 years, et cetera. over the last 5 years, there's been meaningful premium. I'm certain that premium is going to be going forward as well. In terms of where we are finding interesting situations, we like thematic investing. We like developing sustainable themes that we believe will receive flow of capital. I call this transitional capital investing. And if you think about the economy, we've been in transitional economy since the moment COVID hit. First, it was a transition from one, you have the COVID impact, and then the way the economies work and change. So economies that are impacted in a way that require capital to adjust to the new realities in post-COVID and today are receiving substantial amount of capital flows. Financial services is one of them, media and entertainment being another one. I think we have a unique situation right now in Europe where risk is, for the same level of financial risk, you're getting 300 to 400 basis points higher. Now, we obviously know all the reasons for that, tied to the geopolitical situation as well as the energy complex, but that's not the same in every industry. So opportunities persist in the marketplace, and I think credit investors with base rates where they are could be looking to make from 10 to 12 in liquid all the way to high teens in private. And it is I think, Kristen, you make the joke that Tetons are pretty. Yes, it is a good time to invest in credit.
I just want to say, I love, coming from London, I love the fact that during the last couple of days, the positivity I've heard towards Europe. 3 months ago, when I was traveling through the US, we definitely weren't here. And I think our consensus trade sort of 6 months ago was really to pivot towards Europe. We've always not always, but from 6 months ago, really felt that there's been a good relative value uplift, to your point, between the US and Europe and different asset classes. And it just warms my heart to hear, to be here in the US and feel that people are beginning to believe that Europe is not as big a basket case as they thought we were 6 months ago. Although our prime minister that was in place for all of 2 weeks sort of made you wonder for a while.
Got to keep things interesting, right? Yes. There's not enough other stuff going on. On the allocator side, what is the appetite for investing outside of the US? There's a comfort zone, there's a yield. Do you need to go elsewhere? And then I'd also be curious, we all seem quite keen on this opportunistic relative value, the flexibility. Is there still a role for specialists and narrower mandates? So maybe a two-part geographic and then almost more transaction type, and that may vary by investor type.
So I think on the public side, yes, investors should start thinking about where to go abroad, and I think for right now, like up in quality in the US is fine to sort of play there. I think there will be a time for down in quality and out of the US. My concern is that I've been on the road 28 out of 30 days this month. And that means every time I'm traveling, I'm going to see people who are in their offices. They're not traveling. And post-COVID, a lot of investors still haven't gone abroad. They haven't gone to Europe. They haven't gone to Asia. I almost never hear anyone talking about Asia credit, really. It's very few and far between. And my concern is also that there's a tendency, because especially on the public pension side, which I obviously know pretty well, to say, oh, I went to Asia last year. It's to me, that's like buying a house that you saw in the MLS and never actually going to it. I know that was a popular thing in COVID, but now that's over. Go check the house out. And I think that people will be really shocked about the different things they're seeing and hearing when they're on the ground. So number one, I think you should invest abroad, but I don't think you should, not check it out, which is why people hire people like you, right? That you can go abroad and do that. I can't remember what your second question is, but.
If specialization and narrower mandates have a role to play anymore, I know, Carlyle, at Carlyle, you have multiple different mandates.
Yeah. No, I mean, you need to get deep into, that goes to doing the right credit work, understanding industries, being able to help companies. So specialization goes along with the idea of thematic investing. In my mind, we don't invest across every and all given sectors. We do select, a quite broad spectrum, but areas where we believe we have an advantage, and we have a differentiated approach. So specialization matters, although I do think you're asking the question more from specialized strategies like ABS or litigation finance. Is that sort of the question?
Yeah.
I think specialization absolutely matters. I believe that as a basic principle in life. So I think if I've got a toothache, I don't go and see a heart surgeon, right? I absolutely, all jokes aside. But the reality is that I think we've all set the stage for what we think is going to be, a positive, strong year for credit. But it's not going to be a straight line up, right? We've all agreed that. We think there's going to be volatility continuing, given the backdrop. Dispersion is a word that's been used quite a bit on this stage today. So being able to actually go deeper, understand essentially what you need to understand about credit, which is the probability of default. Am I going to continue to bring in income into my portfolio by virtue of the selection that I've made through the different credits, through the different geographies, and through the different risk spectrums that I've put in my portfolio? So absolutely, I think going deeper and specializing is important. A really good example of that, and I keep going back to RegCap, but it is a very exciting space for us. That trade was born not just today, but 9 years ago. We've been investing in it for the best part of 9 years. We've put about $1.4 billion into RegCap strategies through the champion banks in Europe. You need specialization in that area. It's not just a straightforward, straight up trade. You need to be able to analyze the portfolios that you're being presented with. And it's quite a relationship-driven sort of investment theme. We've been working with these banks for the best part of 9 years. A lot of these deals are bilateral, or they're done on a club deal basis. So the ability to specialize, have that depth of relationship, and really be able to scrub the portfolios, if you like, that you're being presented by the banks is absolutely important. So, I think credit specialists are there for a reason. Having said that, I think myopic specialization can be dangerous. So we really believe in relative value. That's what I've continuously, sort of repeated on this stage. So we have a CIO of ABS who's fantastic and sets up his portfolio fantastically. But what I think sets him apart, as way of an example, from other ABS managers is the fact that he sits quite tightly. We're not a huge organization. We have 150 people, and we manage $18 billion in credit. But he sits in an ecosystem where he's able to speak to the guy that manages high yield or the guy that manages loans about the relative value they're seeing in their respective markets and how that could affect, his own asset class. So specialization with a periphery vision, I think, is important.
Begs the question of how much capital do you need? How many people do you need to have the best relative value? That'll maybe be a panel for next year. Maybe a last quick lightning round. We've talked a lot about opportunities. What's something each of you have recently, or your teams recently, passed on or view as being overhyped?
It's a tricky question for me. Pass on or be, well, so I think I'll go back to my earlier comment, and then I'm really confused why people are just focused on like one or two parts of the credit market. Just asset, like specialty finance, I think is super interesting, and I think it can also play on some of the new themes of this new economy and like less on the old themes of the, what was popular pre-COVID. So I would just say like I would look beyond the, shallowness of the credit spectrum.
That's great.
So for us, again, I'll go back geographically. We avoid emerging markets. We don't have a specialization in emerging markets. And actually, there is room for emerging markets in a portfolio. But I would argue, if I go back to the thesis, in times of uncertainty, which is what we've argued here, I think people go back to simplicity and they go back to non-complexity. And so that's what we avoid.
As of now, as of today, I would say it's existing liquid debt. And I say this purposely because I don't think existing debt out there has repriced enough outside of the rates increase that we've seen. It's not repriced enough to provide the return and to compensate for bad structures and bad documentation. Going forward, that may change.
Thank you so much. Please find any of us if you'd like to continue the conversation or debate liquid versus private. Thank you very much.
Thank you, Kristen.
Thank you.